30 days. That's all it takes. 30 days without oil moving through the global trading system, and the world you know, the prices you pay, the job you have, the investments you've built, gets restructured in ways that would take years to recover from. And in 2026, the conditions that could make that happen are not theoretical. They are sitting on a map right now, and most people have absolutely no idea. I'm going to show you exactly what happens to the global economy, to your portfolio, to your cost of living, and to your job if oil stops moving for just 1 month. And then I'm going to tell you precisely what to do about it right now. Let's start with something that most people genuinely do not appreciate about the world they live in. Oil is not just fuel. Oil is not just what goes into your gas tank or what heats your home. Oil is the single most foundational commodity in the entire global economy. It is in everything. It is behind everything. It moves everything. Think about your morning. You wake up, you make coffee. The coffee beans were transported by a ship running on heavy fuel oil. The plastic in your coffee maker, the synthetic rubber in the seals, the packaging your coffee came in, all petroleum derivatives. You drive to work, obvious, but the road you drive on, the asphalt, is a petroleum product. The tires on your car, synthetic rubber from oil. The paint on the lines on that road, petroleum-based. We are so embedded in oil that most people cannot see it anymore because it is everywhere. Now here is the number that should stop you cold. The world consumes approximately 103 million barrels of oil every single day as of 2026. 103 million barrels every single day. That is not a rounding error. That is the heartbeat of the global economy. And the global oil trade, the physical movement of crude oil and refined products between producing nations and consuming nations, is responsible for moving roughly 60 to 65 million of those barrels across borders, oceans, and pipelines every single day. So, when we ask the question, what if that trade stops for 30 days, we are not asking a hypothetical about an inconvenience. We are asking what happens when the heartbeat of the global economy flatlines for a month. And before you say, that could never happen, let me remind you of a few things. In 1973, OPEC cut off oil exports to the United States and several Western nations for 5 months. 5 months, not 30 days, 5 months. Gasoline lines stretched for miles. Inflation exploded. The stock market lost nearly 50% of its value, and the global economy entered a recession that lasted years. In 1979, the Iranian Revolution disrupted global oil supply by only about 4%. 4%, and oil prices doubled within a year. The United States experienced its second major oil shock in less than a decade. Inflation hit double digits. Interest rates were raised to nearly 20% to try to contain it. Now, I want you to hold those historical examples in your mind as I tell you what is different about 2026, because the world in 2026 is simultaneously more dependent on stable oil supply and more geopolitically fragile than almost any point in the post-Cold War era. We have the Russia-Ukraine conflict still reshaping European energy flows. We have Middle East tensions at levels not seen since the early 1980s. We have the Strait of Hormuz, through which approximately 20% of the world's oil supply flows every single day, sitting at the center of a geopolitical pressure cooker involving Iran, the United States, Israel, and Gulf states. And we have a global shipping insurance market that is already pricing in elevated risk for tankers operating in certain corridors. Any one of those pressure points, escalating at the wrong moment in the wrong direction, could trigger a supply disruption that makes the 1973 embargo look manageable. So, let's walk through exactly what 30 days without oil trade looks like, week by week. Week 1, days 1 through 7. The disruption begins. Here is what most people do not understand about oil markets. They run on anticipation, not reality. The moment a credible threat to oil supply emerges, prices do not wait for the actual shortage to appear on shelves. Prices move on fear, on expectation, on the calculation of traders, hedge funds, and commodity desks at major banks who are all simultaneously trying to get ahead of the same information. In week 1, oil prices spike. Based on historical precedents and 2026 market structure analysis, a credible 30-day total trade halt would likely push crude oil from its current trading range, which in early 2026 has been hovering around $80 to $90 per barrel, to somewhere between $150 and $200 per barrel within the first 7 days, possibly higher. The 2022 Russia-Ukraine disruption, which affected far less than a full trade halt, pushed Brent crude above $130 per barrel within weeks. A complete 30-day halt is a categorically larger event. So, what does $150 to $200 oil mean to you within the first week? Gasoline prices in the United States, which averaged around $3.50 per gallon in early 2026, would likely move towards $6, $7, possibly $8 per gallon within days, as futures markets reprice. Airlines, the ones that hedge their fuel costs but never completely, would begin announcing emergency surcharges. Shipping companies, the ones that move every physical product you buy, would begin emergency repricing of freight rates. And the stock market, it would not wait patiently. Energy stocks, airline stocks, consumer discretionary stocks, any company with significant transportation costs in their business model would begin selling off hard and fast. Week 2, days 8 through 14, the physical shortage begins to show. Here's the thing about oil supply chains. They don't fail instantly. Most refineries, most countries, most major economies maintain strategic petroleum reserves and supply buffers that can absorb some disruption. The United States Strategic Petroleum Reserve, for example, holds enough oil to cover roughly 30 to 40 days of net oil imports, though its capacity was significantly drawn down during the 2021 to 2023 period and has only been partially refilled as of 2026. Other countries hold varying levels of strategic reserves. The International Energy Agency coordinates emergency reserve releases among member nations, so the physical reality of shortage takes a week or two to start biting. But by week 2, the signals are undeniable. Diesel, the fuel that moves trucks, trains, ships, and farm equipment, becomes the first critical pressure point. Diesel shortages mean trucking companies start triaging deliveries. Grocery stores don't get restocked at normal rates, construction sites slow down, farmers can't run equipment at full capacity, manufacturing plants that rely on just-in-time logistics start feeling input shortages. The phrase supply chain disruption, which most people now associate with COVID-era empty shelves, returns. But this time, the cause is fuel.
And here is where the 2026 context makes this particularly dangerous. The global economy in 2026 has not fully rebuilt the supply chain resilience that was eroded during COVID. Inventory buffers that companies rebuilt post-COVID are now being managed leaner again as interest rates made holding inventory expensive. A second major supply shock hitting a system that is already running with lower buffers than ideal is genuinely more dangerous than the same shock hitting the more buffered economy of 2019. Week 3. Days 15 through 21, the financial system starts to crack. Oil price spikes of the magnitude we're describing, sustained above $150 per barrel for 2 full weeks, begin to do something that goes beyond commodity markets. They start feeding into the broader financial system in ways that are not immediately obvious to most investors. Inflation expectations, which central banks spent 2022, 2023, and 2024 working extremely hard to bring back under control, begin to re-anchor upward. A sustained oil shock of this magnitude would likely add 3 to 5 percentage points to annualized inflation in major economies within 30 to 60 days. The Federal Reserve, the European Central Bank, and other major central banks face an impossible choice. Do they raise rates aggressively to prevent inflation expectations from becoming unanchored, knowing that rate hikes will further slow an already stressed economy? Or do they hold rates steady, accepting the inflationary impact and risk losing the credibility they spent 2 years rebuilding? There is no good answer to that question, and financial markets hate situations where there is no good answer. By week 3, bond markets are repricing dramatically. Equity markets are in a sustained sell-off. Credit markets, the corporate bond market, the leveraged loan market, are showing spread widening that signals genuine financial stress. Let me take you back through history for a moment, because I think the most important thing you can do as an investor is understand that this kind of scenario is not unprecedented. It has happened before. The mechanisms are known, the consequences are predictable, and the people who understood history were the ones who protected their wealth. The 1973 Arab oil embargo is the most instructive comparison. OPEC nations cut exports to the United States and several allies in October 1973 in response to American support for Israel during the Yom Kippur War. The embargo lasted until March 1974, roughly 5 months. Oil prices quadrupled. The Dow Jones Industrial Average lost nearly 50% of its value between January 1973 and December 1974. The United States economy entered a recession, unemployment rose, and perhaps most consequentially for long-term investors, the inflationary spiral that began in 1973 took the better part of a decade and interest rates of nearly 20% to fully extinguish.
Now, here is why 2026 is different and in some ways more dangerous than 1973. In 1973, the global economy was far less integrated. Supply chains were more local, the just-in-time logistics revolution had not yet happened, countries maintained larger domestic production and inventory buffers. The financial system was not as globally interconnected. A price shock in oil did not transmit to credit default swaps, to emerging market bond funds, to cryptocurrency markets, to pension fund duration calculations. In 2026, every one of those transmission mechanisms exists. A 30-day oil trade halt would not just spike gasoline prices, it would ripple through the entire global financial architecture in ways that are faster, more interconnected, and harder to contain than anything that happened in 1973. The 1973 embargo affected a less connected world. In 2026, a 30-day halt hits a system where everything is wired to everything else. And there is one more crucial difference. The United States in 1973 was a major oil importer with very limited domestic production. Today, the United States is actually the world's largest oil producer, pumping approximately 13 million barrels per day as of 2026. That gives the U.S. a meaningful buffer that it did not have in 1973. But, and this is critical, the global economy does not care only about U.S. production. The countries that would be most devastated by a 30-day oil trade halt are not the United States. They are the import-dependent economies of Europe, Japan, South Korea, India, and the developing world. And when those economies go into crisis, the United States does not escape untouched, not in 2026. The world is too connected. Alright, let us talk about what you actually do with your money right now, because information without action is just anxiety, and I am not here to make you anxious, I am here to make you prepared.
I want to be clear before I go through this. Nothing I am saying is personalized financial advice. I am not your financial advisor, and you should speak to a qualified professional about your specific situation. What I am going to give you is a framework based on how institutional investors and serious money managers position for oil supply shock scenarios. You take this information and make your own informed decisions. First, understand your energy exposure. If you own a broad equity index fund, which most everyday investors do through their 401k or retirement account, you already have some exposure to energy companies. The S&P 500 energy sector represents approximately 4 to 5% of the index as of 2026. In an oil supply shock scenario, that portion of your portfolio goes up, potentially dramatically. Energy stocks were up over 60% in 2022 during a far less severe supply disruption. In a 30-day oil halt scenario, integrated oil companies, exploration and production companies, and midstream pipeline companies could see gains that partially offset losses elsewhere in your portfolio. This is not a reason to dramatically overweight energy, but it is a reason to understand that your current index fund holdings already contain a natural partial hedge. Second, consider the inflation hedge layer of your portfolio. A sustained oil price spike of the magnitude we are discussing would be deeply inflationary. Assets that historically perform well in inflationary environments include energy stocks, as we just discussed, commodity producers broadly, gold, Treasury inflation-protected securities known as TIPS, and real assets like real estate investment trusts with pricing power. In 2026, gold is trading above $3,000 per ounce, already reflecting some level of geopolitical and inflation risk premium. In a 30-day oil halt scenario, gold would likely push significantly higher as a safe haven inflation hedge. A meaningful allocation to gold, whether through physical gold, gold ETFs like GLD or IAU, or gold mining stocks, provides a meaningful buffer. Third, look at your direct oil price sensitivity. How much of your personal financial life is exposed to energy costs? If you have a long commute, if you run a small business with significant fuel or transportation costs, if you live in a region dependent on heating oil, a 30-day oil trade halt hits your operating costs directly and immediately. This is not an investment question. This is a practical financial resilience question. Do you have enough cash buffer, 3 to 6 months of living expenses, to absorb a period of dramatically higher energy costs without being forced to make bad financial decisions? If not, that cash buffer is your first priority before any investment repositioning. Fourth, and this one is specifically for investors paying attention to global markets, watch the emerging market currency and bond exposure in your portfolio. The countries most devastated by a 30-day oil trade halt are emerging market import-dependent economies. India imports approximately 85% of its oil needs. Japan imports nearly 100% of its oil. South Korea imports essentially all of its oil.
A sustained supply shock would create severe balance of payment pressures on these economies. Their currencies would weaken sharply against the dollar, their bond markets would sell off, and their equity markets would fall hard. If you have emerging market exposure through ETFs or mutual funds, understand that this is a meaningful vulnerability in a 30-day oil halt scenario. Fifth, and most importantly, maintain your long-term perspective while making tactical adjustments. A 30-day oil halt is a crisis, but crises end. The 1973 embargo lasted 5 months and felt permanent to people living through it. It was not permanent. The oil market normalized, supply adjusted, new sources came online, the global economy adapted. Painfully, slowly, but it adapted. The investors who made the worst decisions during the 1973 crisis were not the ones who held through it. They were the ones who panic sold at the bottom and locked in permanent losses. Understand the risk, position thoughtfully, but do not confuse a crisis with a permanent end state. Let me bring this home with something that I think is the most important context of all. The question we have been discussing, what if oil trade stops for 30 days, is not just a hypothetical stress test. It's a window into a much larger structural question about the global economy in 2026 and beyond. The world is in the middle of an energy transition. Renewable energy capacity has grown dramatically. Electric vehicle adoption is accelerating. Solar and wind power are increasingly cost competitive with fossil fuels in many markets. And yet, and this is the crucial point that too many people in the energy transition conversation gloss over, the world is still almost entirely dependent on oil for transportation fuel, for petrochemicals, for plastics, for fertilizers, and for the energy-intensive manufacturing that underpins modern industrial civilization. The International Energy Agency projected in 2025 that even in its most aggressive clean energy scenario, global oil demand does not fall to zero before 2050. We are not in a post-oil world. We are in a transitioning away from oil world, and that transition will take decades. That means the geopolitical risk around oil supply is not going away anytime soon. As long as the world needs 100 million barrels a day, and as long as a significant portion of that supply flows through geopolitically sensitive choke points, the Strait of Hormuz, the Suez Canal, the Bab el-Mandeb Strait, the Strait of Malacca, this scenario we have been discussing today remains a live risk. Not certain, not inevitable, but real. And the people who understand that risk, who have thought through what it means for their portfolio, their personal finances, and their economic life, are the people who will navigate it most effectively if and when it materializes. The 30-day oil halt scenario we walked through today is a thought experiment, but the lessons it generates are entirely practical. Understand your energy exposure, build your inflation-resistant portfolio layer, maintain your liquidity buffer, understand your emerging market vulnerability, and keep the long-term perspective that separates disciplined investors from panic-driven ones. You have now thought more carefully about this risk than the vast majority of people who have money in markets right now. That is not a small thing. Use it.
Here is where we land. Oil is not just a commodity. It is the foundational layer of the global economic system. A 30-day halt to global oil trade, triggered by any number of geopolitical scenarios that are not theoretical in 2026, would produce a cascade of consequences that would reach your gas tank, your grocery bill, your retirement account, and your job within days to weeks. It has happened before in different forms. The mechanisms are known, and the difference between the investors who navigate it and the ones who get blindsided is entirely determined by whether they understood the risk before it materialized. You now understand it, so go do something with that understanding. Drop a comment below. What do you think is the most likely trigger for an oil supply disruption in 2026? The Strait of Hormuz? A new geopolitical escalation? Something else entirely? I read every comment, and your answers genuinely shape what I cover next. If this video changed how you think about oil, energy, and your portfolio, hit that like button. It takes 1 second, and it genuinely helps this content reach more people who need to understand these risks. And if you are not subscribed yet, I will be blunt with you, you are missing the financial intelligence briefings that serious investors use to stay ahead. Subscribe, turn on notifications, share this with one person in your life who has money invested and has never thought about oil supply risk. Trust me, you know somebody who needs to hear this. Coming up very soon, we are going deep on what happens when the dollar loses its status as the world's reserve currency and what that means for every dollar-denominated asset you own. That one is going to fundamentally change how you think about money itself. I will see you there. Subscribe to Investify.
More financial videos, real insights, zero fluff. Let's build wealth together.